Welcome to the December Capital Markets webinar. I am not Ryan Herding, as you can tell, and today we're switching it up a little bit. I'm Tina Elmer. I handle a lot of the marketing and manage a lot of this webinar from behind the scenes. So today I'm filling in for Brian and Ryan, and because money never sleeps. But we always have our trusted panelist, Jack Davis, with us. So thank you, Jack, for allowing me to co-host with you today.
Yeah, this is exciting. Tina brings a much prettier face than Ryan and Brian, but thank you guys for joining. Hope everybody had a nice Thanksgiving and is having a good holiday season. For this one, we're gonna start with the usual stuff, talk about recent data, where interest rates are at, and then do a little bit of a 2025 recap, and then do some predictions like we did last year. So it should be a good one. But jumping into interest rates, we recently had a cut in December. So last week, the Fed cut 25 basis points. This was largely priced in, as we discussed at the last one. And so that brings the total of 3 cuts for the year 2025. Last year at this time, I think market was pricing in a little bit more than that. But as you saw, like with tariffs and various other issues, it's been a little bit of a choppy year, but I think we have some positive news going into 2026. When we look at the spread between the 10 and the 2-year, it's widened quite a bit since a year ago. It was holding pretty steady the last few months at around 50 basis points, but on the back of unemployment news on Tuesday and then inflation news today, we've seen the spread widen even more to about 65 basis points, which again is that steepening of the yield curve. And usually steepening of the yield curve is a healthy sign for fixed income markets. We've talked about securitization and what that means. So that's, I think, a positive sign looking into 2026. And then when we think about the Fed's next meeting is January 28th. Right now, market's saying 75% chance of no cut, but it's pricing in 2 25 basis point cuts in 2026, one in March and one in July. So when we think about where that will put rates, we've always talked about how just because the Fed cuts the Fed funds rate doesn't mean we see long-term yields come down. But I do want to do a little bit of a thought experiment. So right now, the spread between the 10-year Treasury and the 30-year mortgage rate is 215 basis points. And when we met a year ago, that spread was about 250 basis points. And when we did our predictions, I gave a prediction on a lower 10-year, but also said I'm hopeful that spread between the 10-year Treasury and 30-year mortgage would tighten to around 220. I was close. Right now, it sits at 215. But the good thing there is that's right in line with sort of the historical average of the spread between the 10-year and the 30-year mortgage. So that's a good sign. And then if we think, okay, right now the 10-year Treasury is about 50 basis points above the Fed funds rate. So if the Fed's going to cut 2 more times, that's just what the market's pricing in. There's no certainty there, but let's say the market's right and the Fed cuts 2 more times in 2026. If that spread between the 10-year and the Fed funds rate were to stay constant, that would put the 10-year Treasury at around 375. And then if we think about the spread between the 10-year and the 30-year mortgage rate, if that spread also remained constant, that would put our 30-year mortgage rate at about 5.8, 5.9%. So under 6 at the end of next year. Now this is all just,
but it's exciting.
Yeah.
And not to interrupt you for a second, but I will say, as somebody who obviously has been behind the scenes of seeing all these amazing webinars, you've been pretty spot on, JD. Your predictions are usually like pretty. We're gonna get into it as to who is maybe the most right for bragging rights, but I would say, I think you had mentioned your thought was that we would have 2 cuts last year. So 3. I mean, it's pretty close.
Yeah, I mean, I think there's a lot of luck in that, and I think I'll give my best effort again this time around. But I think bottom line is the fixed income market, the yield curve. It all looks good. It's within sort of historical norms and it looks healthy. So I think that's positive for 2026. And There's no certainty around how many cuts we're going to get and how these spreads are going to look. But as it stands right now, I'm optimistic for 2026.
That's good. Well, optimism, we like that. And I'm sure the borrowers want to hear that as well. So for sure. Well, thank you.
And then just to give a quick update on unemployment and inflation. So this has been a big week for data. Tuesday, we had the unemployment rate print, which was big because given the government shutdown, we never got October data. And so everyone was kind of, anticipating this print, excited to see where the numbers came back. Unemployment actually came in at 4.6%. So that's up. That's up 0.2%. And that kind of puts it right at the upper range that the Fed likes. So the Fed targets between 3.5 to 4.5. And so inflation at 4.6 is pushing that upper bound. So obviously there's some softening in the labor market. And then inflation, which we got this morning, inflation was actually down. So inflation year over year was down 0.3%. And I've talked about it in the past, the sort of that environment where you can see yields come down is usually steady inflation and rising unemployment. And so that's what this data supports. And we are seeing the 10-year tick down today. Right now it's sitting at 4.12. So it's down like 5 basis points on the day and down earlier this week. So that's sort of, if you're all about the 10-year coming down, that's what you want to see is inflation remaining in check, and the unemployment rate, kind of a soft labor market.
Good. Well, that all sounds optimistic. I mean, I feel like a lot of the Jay Parsons and Resi clubs and the blogs are stabilizing a little bit. So we'd like to hear some optimism, though. I think that would be, again, exciting news for us, for sure.
And then I do want to just talk through one more sort of markets thing before we get into the fun stuff. So everyone knows Jerome Powell's time is coming to an end in May. And there's been a lot of talk and anticipation about who the next Fed chair is going to be. And for a while, the betting favorite was this guy, Kevin Hassett. He's ultra dovish, which means sort of aggressive towards cutting and keeping rates as low as possible. And obviously, President Trump's been very vocal about wanting low interest rates. He said that he wants
1,000-year mortgages.
Yeah, he said he wants the lowest interest rates in the world. And so for a while, this Kevin Hassett was kind of the betting favorite, seen as like Trump's guy. But what's interesting is that he got a lot of pushback from sort of the institutional finance world. So when we think about the big banks, the JP Morgans, the Goldman Sachs, many of them didn't like Trump's pick. They didn't like this Kevin Hassett guy. They thought he's overly aggressive. They thought if he lacks experience, lacks credibility, and if he's just going to be kind of the president's puppet and slash interest rates to the floor as quickly as possible, that puts a lot of inflation fear into the market, which actually causes long-term yields to rise. And so it's interesting. I wish I prepared this chart, but if you look at when Kevin Hassett became the betting favorite to become the next Fed chair, and you look at what long-term interest rates did in the following months, they rose substantially because the market, the big players were afraid that if this guy gets it, he would be too aggressive in cutting.
Yeah.
And so now President Trump has seen he's seen that sentiment and he's sort of adjusted his mindset a little bit. So now there's a new betting favorite, another Kevin. His name is Kevin Warsh, who has a lot more experience. He's still what they consider a cautious dove. So he's not like a hawk, all about hiking rates, but he's still a dove. So he likes lower interest rates, but he's a lot more cautious. And, the institutional players like his name a lot better. And since he's become the betting favorite, we've seen those long-term yields start to actually come back down. So just thought it was an interesting tidbit to look at. And, we'll have to see in May who ultimately takes the job. But
yeah, I mean, I know that we've seen the cuts don't necessarily equate to like much lower rates per se, but it would be great to see some of that affordability.
Yes.
We love to joke that, it'd be great to buy a house someday.
It would be.
But unfortunately, affordability is so through the roof.
Yep.
So maybe some of this will change some of that. So, well, thanks for all of that. It's super insightful. Always great to get your perspective, JD. So now let's go through where you guys stacked up last year
the fun
and
stuff,
and how we're going to see it for this year.
So 10-year treasury yield. We have Ryan and Brian aren't here to defend themselves, but last year I predicted.
I love how you let me just sidebar here,
Yeah.
like how you green highlighted who was the winner.
Yeah, I tried to distinguish sort of who are the winners. And so for the 10-year treasury yield, I have, the least amount of years of experience, but I'll give myself that one. Right now it's sitting at 4.12. So I was the closest there. So I'll take that as a big win. Markets that we're most bullish on in 2025. So I think I'm kind of the loser here. So hand up, but Brian said Columbus. And if you look at sort of home prices, year over year change, the entire state of Ohio did really, really well. So I'll give Brian the win there. And I think, Ryan also did well, North Carolina, Tennessee. I think, and I think there's, for all those markets, Columbus, North Carolina, Tennessee, I think there's tailwinds still for 2026.
Yeah, 100%. I think the Midwest and Carolina showed resilience, and the rental growth stayed strong, and it seems like those numbers maintained pretty well.
Bearish. So we all said Florida.
You were all right.
That's kind of an easy, We kind of, that was kind of an easy cop-out answer. But Southwest Florida specifically, hit very hard with oversupply coming out of COVID, and then also rising insurance costs, really made Florida a challenging market. I'm giving Ryan the win here, though, because he said maybe Philly. So I'm giving him an additional point there.
Because Philly was tough.
Yeah, I wouldn't say Philly, performed super poorly, but I think, there's some headwinds for Philadelphia, and I'll talk about that in kind of the 2026 predictions. But I think Ryan was right. He was early on that one, so I'm trying to give him some credit.
Yeah.
But.
Nice.
Yeah. Biggest surprise for real estate investors. Rates higher for longer. We kind of we're all in agreement there, and that proves to be true. That rates ended up being higher for longer, but we're starting to see some positivity moving forward. And then I like Brian's point about meds and edge driving real estate investments. So, the areas where the builders are going to look to continue to develop, and where you can expect to see home prices appreciate or remain stable. It's going to be those big, medical and education centers. So you got hospitals, you got schools. Those are always going to be real strong driving forces behind.
Yeah, they're driving the growth, which is great. So bringing jobs to the area, development, construction. So as people grow in those sectors, obviously will help construction and growth.
Yeah. So as you think about your own your own real estate investments, it's always good to pick markets where there's strong, medical and education development going on. Yeah,
and shout out to Sean Pincus last month, who said also look at the Whole Foods for things like Target and Whole Foods and like those, where are those, because they do so much market research about when entering a market. Like I think he said that some 150,000 people a month have to traffic through, so I think when you see those kind of retailers and medical and educational companies coming in to an area, it's going to bring growth for the sure.
100%. So. Follow the jobs. It really comes down to following the jobs. Yeah.
Exactly. Awesome. Well, so you guys did well. Oh, we didn't touch the most fun one. Most fun one. I love this one.
Yeah, this is why I think I really take the cake and won the whole thing because
you said OSU.
I said and the Eagles. Yeah, it was kind of split, right? I took the first question, Brian took the second, Ryan took the third.
Yeah.
We all got credit for the fourth, but Eagles won the Super Bowl last year. Hallelujah.
Thank God.
Go Birds. I nailed that. Penn State, didn't Penn State didn't make it. So Ryan was right about that. But I did say I was worried about Ohio State, and they did win the national championship
Yeah, they
last year.
did.
So,
But as we just discussed, they're not in the running now. So,
Ohio State, they're good this year.
oh, they are. I thought they were
Yeah.
like still struggling.
Penn State is not in the running anymore.
Penn State.
Yeah.
Penn State. I'm obviously not. NFL can talk about all day, but I'll just defecto to you on the college
problem.
football. Awesome. All right. Well, let's go through some predictions for 2026. Again, I think that we're probably going to be similar. I mean, I'm not seeing so much change. There's some incremental change in my mind, but I'd love to see what you think and get your thoughts as well.
Yeah, I given my success last year, I do want to take some shots. We'll see if I get the luck like I did last year. But where will the 10-year Treasury yield land at the end of 2026? I talked about how that spread has come down between the 10-year Treasury and the 30-year mortgage. So I'm hoping it remains constant, 220 basis points. That's in line with the historical average. So I'm hoping to see the 10-year come down to 375, 3.8, and then hopefully we see that 30-year mortgage rate right around 6, maybe sub 6%. Optimistic. I'm being optimistic, because I want to buy a home one day. So
yeah, and I'm in the same range. I mean, I have 375 to 4. A little bit higher than you, but I think with the cuts, as you're saying, like we have a few cuts in there. I think the labor softening will become visible, and so we will still have some steadiness. I don't think we'll have a huge drop, but I mean, I would love to see, just because I have a real estate background, so certainly would love to see the rates come down, and like we talked about with that affordability. It's such a tragedy about how hard it is for people to purchase a home now, and just like all this, I think I read something that the rates would have to be in the like 2s to 3s to really get back to pre-COVID numbers, which is just crazy. So hopefully we'll start to see something, and I think inventory would pick up, and then you have that second home market that can move again. So all that would be helpful. So hopefully we'll see that from that. My 3.75 is kind of where I landed as well. So.
Good. Yeah. I read something today that was like more people that are 60 years old are like buying second homes or buying their retirement home. There's more activity in the home market for 60-year-olds than there are for 30-year-olds.
Yeah, 100%. I mean, it's just crazy.
Yeah.
It's like, well, they called it, I think it was like they were terming it the silver tsunami.
Yeah, exactly.
For a while. So I was like, the silver tsunami is going to reignite the housing market, but it hasn't quite done that. But, certainly, they have the cash, which, helps. So maybe someday, Jack, we can dream.
I will dream.
We'll get there. So what do we go to next? We have the most bullish markets.
Yeah.
Okay. So I kind of echoed Ryan from last year. I think Carolina and Tennessee, mostly because I've spent time there recently. We were just in Nashville, and there's a lot of growth going on, specifically right outside of Nashville and beyond in the suburbs. I've seen a lot of the regional and national home builders are really buying up the land there. And so I do think Tennessee is going to do really well. And then Carolina, shout out to our Carolina boys. We have some great territory managers, and they're doing great in the state there. And just, the amount of transactions that we're seeing just on our level makes me, have good strength and feelings for 2026 in those marketplaces.
Yeah. I mean, that's a great point. Where we sit as a lender, how much North Carolina, South Carolina have grown as part of our book, and
it's not anchoring. So amazing.
So yeah, I think that's really positive. I agree with you. I think the Carolinas, I think Georgia, really that Southeast, that's the national home builders buying lots of land there. They know, they have the data and they know these markets better than anybody. They're following the jobs. So I think the Southeast is definitely still bullish. And then I'll talk about like Dallas, like if you look at the Dallas Fort Worth area, for example, year over year, there's been some sort of softening if you're just looking at like home price appreciation. But
Mm-hmm.
again, like following the jobs, there's following, the medical jobs, education centers, schools, like even though there's some softening just on a pure sort of home price, at a pure home price level, just the amount of investment from major companies to build, new offices there. I think Dallas will continue to remain strong, even though if you're looking at the data, sometimes it might look like it's softened. But I still think there's a lot of good tailwinds for
Yeah, I did
Dallas.
see some stuff on Texas too. So I did think that was like kind of the outlier, but I agree.
Yeah.
So hopefully, and again, I feel like I'll favor the ones that we have some
Yeah,
guys there. So let's, for
exactly.
their sakes and ours, we'll just keep seeing some big growth there
Mhm.
in Texas. So what do you have for bearish? You sticking with Florida? You going
Yeah.
back?
Oh, so I think, yeah. I mean, I think Florida, I don't know if Florida's quite bottomed yet. I think it's close though. So I think, Florida really struggled last year, especially Southwest Florida. But maybe I think as we look to maybe the end of 2026, they start to rebound
Mm-hmm.
once sort of that oversupply has come down and the supply demand dynamics have equalized a little bit. Then I think you could see the market rebound a bit. But the insurance thing is still,
Yeah, the insurance is still
that's going to be an
yeah.
uphill battle for
sure.
for
I'm also
time to
interested
come.
to see. We don't really do that much there, but in the Manhattan area and with some of the geopolitical,
Yeah, the
like some of the stuff that's going
mhm.
on with some of the administrations that have come in to some of these major markets, like if that's going to change, if the social economics are going to change some of that
Mhm.
landscape, and create some slowdown there. Because I feel like we saw with COVID, a lot of people coming from the Northeast to the South. It will be interesting to see if there's some driving factors, if that happens again, out of New York
Yeah,
and into, some other states.
that's a good point. A
So,
lot of people are interested to see what happens in New York, given
yeah.
the politics. So we'll have to keep our eye on it. And then I do want to bring up Philadelphia.
Don't
I'm
hate on Philly, Jack.
I'm not like, bearish on the entirety of Philadelphia, but I do want to bring up some things that I feel are important. We have seen somewhat of a pullback in Philadelphia as far as institutional capital
Mm-hmm.
goes. I think, you know, market. So there are plenty of very strong areas in Philadelphia, but I think if you're looking like, North Philly, I think is going to continue to struggle. And something we saw come out recently is there's been this fraud that's been
Yeah,
unveiled.
I know. It's
So
crazy.
a few months back, we had a big fraud situation pop up in Baltimore. Something similar is starting to be uncovered in Philadelphia, where
At Temple, right?
yeah, in sort of the Temple area, where there's some I think appraisers involved, a couple of different borrowers involved, maybe some title companies. Thankfully, we're unaffected, but fraud causes fear,
Mm-hmm.
and institutional capital does not like fear. So there seems to be a bit of a slowdown from institutional capital investing into the Philadelphia market. But I think one of the positives is that can be an opportunity for somebody like us to continue to service our borrowers. And I think one thing we're really proud of is our underwriting team and how good of a job that they've done
Yeah,
underwriting,
totally.
avoiding this kind of mess.
Yeah.
It can be easy to get tied up in something like this if you're not really paying attention to the fine details of every transaction. So hats off to our underwriting team.
For sure.
They've done an amazing job. We haven't gotten caught up in any of this, and that'll give us staying power in the Philadelphia market because we've been unaffected by the fraud, and we have a track record of working with the right people.
Yeah, it's better to stay stringent on the front end
Yep.
and then have everything, then the ducks in a row, than have the surprises on the back end for everybody, for the borrower, for the company. So I agree. That's been good for us. So we're glad we're not caught up in that mess. Or Baltimore,
Yes.
right? That's another place that had the
Yeah,
same fraud
Baltimore
stuff.
had it too a few months ago, but yeah, again, same story. Like we didn't get caught up in it. So we're able to, to keep those relationships and, continue. And I'll say this, like, if you're, sometimes I'm not going to name any names, but we feel there's some groups out there that maybe aren't as stringent on the upfront underwriting process. And maybe that can feel great as a borrower. But if your lender gets caught up in something like this, they can fall off the map pretty quickly and kind of leave you hanging. So it's important to work with groups that put the work in and do the right thing. So
100%.
I'll say
Totally. Good. So what do you think will be the biggest surprise for investors in 2026? Are you positive or negative? Optimism?
Yeah. So I guess I maybe have one positive and one negative.
That's good.
I think as a whole, that oversupply that started in COVID. So you think about COVID, work from home, people, maybe leaving the Northeast because it's cold and they think they're going to work from home the rest of their lives. So they're going to these nicer areas near the water, warm weather. Obviously, we saw a lot of those markets get really oversupplied and then sort of slow down last year. But I think the supply demand dynamics in a lot of those markets is rebalancing. And so hopefully throughout 2026, we start to see some of those markets that have struggled the last 12 to 24 months start to rebound.
Great.
And then, I think multifamily, similar story, like got hit real hard. Commercial. So really like office got hit really hard. Like I think people are coming back to the office. I think office is really starting to rebound. I think multifamily also had a bit of a oversupply shock that is starting to equalize. So I think multifamily will rebound. So I think overall things are looking really, really good for 2026.
Yeah, I did see that. I think it was JP Morgan just knocked down a massive building and built another building in corporate headquarters in New York. And they're saying that Class A office space and Class B office space is like, we're going to see a lot more growth there. And if you're not keeping up and you're in the Class C, like you're going to have to start thinking about some new ways to, get tenants in.
Yeah.
Keep that
occupancy. So I think, and that presents opportunity, I think, for real estate investors is thinking about, turning Class C into Class B or Class C into Class A. So.
Yeah, 100%. Well, so I have that. I think you're going to start to see, especially because what you had said in the beginning, some debt market stabilization before we see the transaction volume start to change. Yes. So I think that the markets will probably moderate in 2026. And my sense is that we won't necessarily, maybe towards the tail end of 26, we'll start to see the more volume in transactions and less, maybe not right away, like more or less like what you say, as far as the rates will adjust, but we won't necessarily immediately feel that as the consumer or the borrower on the commercial or the residential side immediately. Yeah. So I think we'll see.
I agree with you. I think I feel very positive about sort of where the yield curve is right now, and very positive around how institutional capital feels about the yield curve and fixed income markets. And I think that it'll take time for some of this to be reflected in real estate, but I think it's coming.
Yeah. I also think that some of the other stuff that we might see, which might not be as positive, is some of that labor market softness in construction industry, especially with some of the deportation.
Yeah.
Some of the, just some of that stuff is, I think, going to show up a little bit in 2026, and we might have some slowdown in the construction process. Hopefully not, but
hopefully
I think that, that might be my negative.
That's a good point. You got to give something nice. I think
so. That might be the one thing that I'm hoping that doesn't happen, but we like to be optimistic here.
And
so,
I do want to give one negative.
Yeah.
And it's very applicable to our business and our customer group. I do think 2026 we'll see some stricter underwriting requirements, particularly for DSCR loans. I think, one side of it's, I think, like the fraud thing has really scared institutional capital in this DSCR space because, where people are putting maybe 20 grand into a fix and flip, and then it's appraising for 200 grand more than they purchased
Sure.
it for. I think you'll start to see, I think, that 3 to 6 month cash out is gonna be tough. And I think you'll start to see, lenders kind of pull away from that and start to really dive into these appraisal values, I think, harder as a
Yeah.
result of this fraud. And then also looking at, vacancies, there's a lot of lenders out there that will write these DSCR loans on vacant properties. We do it too. But I think institutional capital is going to start to push back against, a DSCR loan when there's not a tenant in there, when you're
Sure.
just looking at market rent. Because I think there's been some performance issues on those vacant properties
Yeah.
at a portfolio level. So I think we're going to see some stricter underwriting, but I also don't think it's necessarily a bad thing. Like I think it can help our borrowers, perform better if they wait until they get a tenant in. I think, that's a safer place to be as a borrower, where you have cash flow that can actually cover, your debt payment, your tax payment, your insurance payment. So I think overall it's a good thing, but, at a first glance, some of our borrowers might not be happy.
Yeah, it's getting harder to do that for sure.
Yeah.
To find the right tenants that can get into these properties. So,
Yeah.
well, hopefully not. We won't see it as much, but I definitely think it's going to happen. I agree with you there. For the underwriting, it has to get stricter. But I did have some conversations recently with some of our borrowers, just about they appreciate it, right, on the front end, because then like you're not surprising them in the 11th hour and telling them no, like gives them time to, regroup and restructure and hopefully work together with our partnership as to finding the best way to help them, without
100%.
Without just being like, hey, here's all the money, without like
Right.
we're all going to be in trouble together. No thanks.
Right. That's exactly right. The partnership piece. We don't want to rush them into a loan that, if they're going to, struggle to make payments because they don't have a tenant in there, and then it becomes like a whole disaster. We want to be good partners and set them up for success. Like that's what it comes down to.
Exactly. So. Awesome. Well, good. So now, are we at the fun one? At
Yeah.
our Super Bowl, winning the Super Bowl and college football playoff. So you won last year. Do you want to go second or first this time?
I don't. Let's hear it from the
Okay, so
expert.
college, I don't really know. I mean, I'll just be honest. I'm really not like a college football girl. But I went to Indiana because I Googled it. There's apparently a Cinderella story, and Jack mentioned that to me earlier today. So, and I have some friends in Indiana, so I'm going to give them a shout out. So it's Indiana for the college championship, and then NFL. I feel like it's a mixed bag right now, but I really would love the Eagles, but they're not really. I don't see it. I'm sorry, birds. I feel like I would probably give it to the LA Rams. I think I'd like to see Stafford, maybe the Broncos, just because I like saying the word Bo Nix.
Yeah,
I think
it's a good name.
Such a crazy name.
It's a good quarterback.
But I think like you should. I think a vet. I would like rather see a veteran quarterback take the Super Bowl. So I go with the Rams. And they're not necessarily in our, right in our conference, so I'm not gonna feel too guilty.
Good research there. I will say, I'm with you. Especially in the NFL, would love for the Eagles, obviously, as an Eagles fan, and I don't like the Rams really, because they always kind of play us really hard. Even though we've had their number the last few years, they always play us really hard. So I'm always nervous against them. I do think they have the best team this year.
Yeah.
I do think the Rams will win, and it's exciting to see kind of a different NFL makeup. Like sort of the Titans have fallen a little bit. The Chiefs are out.
I know, it's crazy. The Chiefs
Finally.
being out. I know, it's like a dynasty. It's gone.
We hope Patrick Mahomes has a quick recovery, but finally, they're not in the playoffs.
Yeah, totally.
Will him and Kelsey ever play again?
I don't know.
Together? Probably not.
I know.
So kind of an end of an era, but I think the Rams are the best team. Either way, it'll be exciting because it'll be nice to have some new faces.
Yeah, it's exciting. I think it's always fun to like be surprised, right?
Yeah.
And see like, I mean, I don't know. I think it's like anyone's game still.
It is.
There's not like a structured favorite like last year.
Yeah.
We were kind of the surprise in the
exactly.
long run. So which I'll take all day. But I think it's been an interesting NFL season for sure. So, well, definitely, I think, 2026 seems like it's going to be, like we said, more stabilization,
Mhm.
a little more dispersion year. I think location's going to matter more than anything. But, it'll be interesting to see how it shapes out. But thank you for allowing me to co-host with you today. Any
My
final notes
pleasure.
that you'd like to add on here that we want to just kind of throw out there for people to know? I mean, you made some good points, I think last year as well about just, again, rate cuts
Yeah.
don't mean instant money in your bank. any
Right.
any last minute tips or
I will real quick, just so I can get it down. My college pick is Ohio State,
oh
but
yeah,
we can move on from that because I don't like
because you
them.
don't want to talk about it
Yeah.
anyway as a
Um,
PSU
yeah, we
guy.
can move on from them. But yeah, summary. I think it's been a choppy year. But the last few months have brought me sort of a lot of confidence for sort of the future, because I think like there's a lot of certainty right now in the health of the fixed income market. Where the unemployment rate is, and where like inflation's still in line. That sets the Fed up to cut a couple times. And yeah, like we said, just because they cut doesn't mean long-term rates come down. But I think we'll get a couple cuts in 2026, and as long as there's not like there's no war that breaks out, or there's no COVID 2.0, I think we're in good shape to hopefully see the 10-year maybe tick down a little bit. Hopefully that 30-year mortgage rate comes in a little bit. And we just kind of hopefully slowly grind further towards a positive, healthy debt market, which will ultimately free up, some of the real estate investment. So
Perfect.
that's
Awesome.
kind of my summary. I think thank you everybody that's been joining
Yeah, exactly.
for the last for the last year. It's been fun doing these, and um, it's we look forward to 2026. We've got big things coming, so you'll have to stay tuned. I think more interviews with other people, which we've gotten really positive feedback around, so that'll be good.
Yeah, I know Brian said, or Ryan, I think, mentioned that we have somebody, I'm not sure exactly who, but maybe someone on the land side might be coming in
Cool.
on January. They'll be back. It won't be me. Brian and Ryan will be back in January, so you'll look forward to that. And but it's been good to mix in some of our own people as well, and
Yeah.
lots of great information here. And if you guys have questions, obviously you can always reach out
Yep.
and get more info and anything we can answer.
Feel free to email me with any questions, but
I don't know if do we have pause for
yeah.
any, I don't think we have any audience questions. Do you guys have anything? Are we good there, Terry?
You're all good there.
Okay. All right. Well, let's call it. It's
Yeah.
the holidays.
Thanks for joining,
Thank
Tina.
you for having me. And we'll see you. I won't see you, but I'll see you from behind the scenes.
Yep.
And we'll see you guys next month. Have a great Christmas, Hanukkah, Kwanzaa, whatever you celebrate. And we'll see you in 2026.
Exactly. Happy holidays.
Thank
Thanks for
you.
joining.
Bye-bye.